What if I told you that for decades, the world's biggest banks were secretly manipulating the price of money itself? That your mortgage, your student loan, your entire financial future, it was all tied to a number that was fundamentally a lie. This is the story of a crime so big and so quiet that most of us never even knew it was happening. It's a weird question, isn't it? But it's literally what banks do every single day. The price of money is just the interest rate, what it costs to borrow it. But what happens when the people setting that price are the exact same people betting on where it's going to go? Okay, get ready for this number. $350 trillion. That is the mind-boggling value of all the financial contracts in the world. We're talking student loans, credit cards, corporate debt, you name it, that were all pegged to this one single obscure number. And for more than 30 years, that number, the very number that our whole global economy was built on, was being systematically rigged. It was a complete and total lie. So let's get into what this number actually was. It was so influential that people in the know called it the world's most important number. And yet it operated almost completely in the shadows. It was called LIBOR, the London Interbank Offered Rate. Now, you can think of it like the wholesale price of money. It was supposed to be a measure of trust between the big banks, setting a baseline that determined the cost for pretty much every other loan out there. It really was the invisible heartbeat of the entire financial system. So you'd think a number this important would be calculated with, extreme precision, tons of oversight, right? Well, that very assumption, that's the weakness that allowed the whole system to become corrupt. So here's how it worked. Every single morning, a group of major banks were simply asked a question. Hey, what rate do you think you'd pay to borrow from another bank today? They'd each send in a number. The highest few and lowest few were tossed out, and the rest were averaged together. That average, that became the official LIBOR rate for the day. That's it. Deceptively simple. And right there, that was the fatal flaw. The whole thing was based on estimates. It was an honor system. It was not based on actual, real-world transactions that you could check. Nobody was verifying if the numbers they submitted were even real. They just trusted these massive institutions to tell the truth. This quote from an analyst just nails it perfectly. The same banks submitting the rates had huge financial incentives to see that rate move up or down on any given day. There was no referee in the room. So when you have a system that's built on trust but packed with incentives to cheat, well, what happened next was pretty much inevitable. This is how they pulled off the perfect, invisible crime. The way it worked was just shockingly easy. Let's say a trader has a huge position that'll pay off big if interest rates go down. They just send a quick, instant message to the person in their own bank who's responsible for submitting that LIBOR rate. That person just nudges their bank's estimate down a tiny, tiny fraction of a percent. But when you combine that with all the others, that tiny nudge was enough to pull the whole global average down, making the trader's bet pay off big time. And I'm not making this up. This is an actual quote from chat logs that investigators found. It sounds like something out of a bad movie, not a conversation controlling trillions of dollars of the world's money. A favor worth millions, traded for a bottle of champagne? It's just incredible. Now, here's the crucial thing to understand. This wasn't just one or two rogue traders acting alone. This was a widespread culture of collusion. You had traders from supposedly competing banks coordinating in secret chat rooms with names like, get this, the cartel. It was so routine, it was just seen as part of the job. And that the beauty of it for them, or the horror of it for us, is that it left almost no paper trail. It was a crime hidden in plain sight. For years, this whole system just chugged along quietly. But then, during the 2008 financial crisis, the lie took on a new, even more dangerous purpose. And this is when the first cracks really started to show. See, in 2008, banks completely stopped trusting each other. Lending just froze up. Now, that should have caused LIBOR to skyrocket to reflect all that risk, but it didn't. Instead, banks started submitting artificially low numbers to pretend they were healthy and stable, even when some were on the verge of collapse. As this economist put it, the system's main health gauge was telling everyone the patient was fine while they were having a full-blown heart attack. A lie like that just couldn't hold forever. That deception during the crisis made people suspicious. And by 2012, whistleblowers and investigators finally blew the lid off the entire decades-long scheme. The fallout was just immense, and it took over a decade to finally unwind the whole system. LIBOR was only officially retired for good in 2023. And when the scandal broke, it spread like wildfire. This wasn't one bad bank. It was basically a who's who of global finance. We're talking household names. Barclays, UBS, Deutsche Bank, JP Morgan, Citigroup, they were all involved. The entire system was rotten from the inside out. So in the end, the total fines paid by all of these banks came out to around $9 billion. And okay, that sounds like a lot of money. But then you put it next to the amount of money that this rigged number actually influenced, 350 trillion, that 9 billion, it's not even a rounding error. So the penalty wasn't a real punishment. It wasn't a deterrent. For institutions that deal in trillions, a few $1 billion is just another line item on a spreadsheet. It was just the cost of doing business. Well, the scandal forced regulators to finally kill LIBOR. So the really big question now is, has the system that replaced it actually fixed the problem? Or is it just more of the same? So the replacement is called SOFR. And look, on paper, it is a huge improvement. Instead of being based on what banks say they would pay, SOFR is based on data from actual, real, verifiable transactions. It's built to be more transparent and a whole lot harder to manipulate. But there's a more cynical way to look at all this. The financial system is driven by incentives, right? And the incentive to find an edge, to bend the rules for profit, that hasn't gone away. The specific trick they used with LIBOR might be gone, but the culture that allowed it to happen for so long, it might have just evolved. And that kind of leaves us with this final thought. We've got a new rate with a new name, and it's based on new rules. But is it truly a new system? Or have we just fixed one bug in a system whose fundamental code, that relentless pursuit of profit no matter what, remains exactly the same? That's a question worth thinking about.